would say that when I first saw these revisions last Friday, I was very surprised. Is it true that the economy indeed is actually was about to pick up, and this revision is just a fluke? Is the economy, the labor market, as weak as this 35,000 3 months hiring trend is suggesting?
Anna Wong, Chief U.S. Economist at Bloomberg Economics. It is so wonderful to welcome you to the show. Great to meet you for the first time. Really thrilled to have you joining us today, Anna.
Happy to be here, Julia.
Well, we are happy to have you, and I've wanted to interview you for a long time. We've had guests who've referenced your work, including Dr. Lacey Hunt, who called you an excellent economist. And a lot of folks who watch the show, they will have followed you on X and be familiar with your work. For those who aren't, I'm excited for them to get to meet you, get to know you, get to learn about how you think about the world. And one of the things about this show, Anna, is we always start with the big picture, that macro view, more of that framework in which you're looking at the economy and the outlook, what that baseline is for you today. So let's start there. Big picture, the state of the US economy, and you can take all the time you need to set the table when it comes to that big picture view.
Big picture. It sounds harder than the question seems, because last Friday's payroll basically flipped the big picture upside down. So let me talk about the big picture, our view before last Friday, as we are still sorting out last Friday's payroll number and what that means for this big picture. So before last Friday, what we are seeing is some I would sort out economic data into backward-looking and forward-looking ones. The backward-looking tells you that, well, in the past 3 months, things have slowed down. GDP data tells you that if you strip away the volatile component like trade and inventory, in fact, the private domestic sales have been slowing to close to about 1.2% in the first half of this year. And when you think about the slowdown in population growth, we estimate that it slows down from 0.9% last year to 0.4%. So that translates to almost a one-on-one slowdown in potential GDP growth. It means that the GDP growth rate that is consistent with the population growth is roughly 1.2, 1.3%. So basically, actual GDP number in the first half slowed to that around that now lower potential GDP growth rate. So the forward-looking indicator, though, seems to suggest that the recent trade deals reduced uncertainty from the tax bill as well as in the trade policy front will likely boost investment in the future. So earning calls, you see that many firms are thinking about unleashing that delayed investment from the first half of this year. So the forward indicators would suggest that we are going to see investment picking up in the second half of this year. Even in the jobs data, so we rely on alternative data, non-official, unconventional data to gauge what's the underlying momentum for the labor market. I also thought that I see signs that certain slowdown last couple of months was stabilizing. So now, after last Friday. So last Friday suggests that the 3 month pace of job growth has slowed to only 35,000. And that is even before any of these birth and death model statement that I've been pointing to for most of last year. So my estimate is that real-time payrolls overstate underlying job growth by roughly 80,000 per month on average for the whole year, meaning that for the entire year of this year, I'm expecting eventually 800 to 900,000 downward revision for the entire year. And that would be coming from, those revisions would be coming from the benchmark revisions that will happen in early 2027. I didn't expect to see the revisions now. I'm expect to seeing it 2 years later. So I was surprised by how fast these revisions are. It happened within 2 months. So if you look at the size of the revisions, it's basically about 100, 130,000 per month downward revisions. In fact, from June, May, and also March, the revisions from the first print to now to the third print is about over 100,000 per month, which is humongous, right? Especially for anything that's outside of weather-driven or unusual recession business cycle turning points. So that's where we are. So we are all as is anyone on Wall Street right now, trying to figure out whether these massive 268,000 2-month downward revisions we saw from last Friday indeed is a signal. Will those downward revisions be ultimately revised up next month? That's something that we are looking at. And the answer to that question will determine whether is it true that the economy indeed was about to pick up and this revision is just a fluke, or is the economy, the labor market, as weak as this 35,000 3-month hiring trend is suggesting?
That's the question then. Do you have a direction that you're leaning in or leaning toward?
Yeah, so I will say that when I first saw these revisions last Friday, I was very surprised. As I said, I had expected downward revisions uh, of 80 to 100,000, but I was expecting it in the benchmark, not immediately in real time. So that's number one that I was my surprise where my surprise was. Second, in terms of the source of the revision, we have seen that much of it came from, for example, in June, there was about 130K downward revision. Initially, the real-time payrolls read 147K jobs added. Now it's only 14K. And so almost half of that downward revision came from state and local government, which BLS relies on administrative data to collect. So there are many explanations out there on why there was such a big downward revision. Part of those explanations include its seasonal adjustment, it's the low response rate. But I found that neither of those two explanations are satisfying, because clearly the downward revisions happen in non-seasonally adjusted payrolls and at the government level, a lot of it, in fact, half of it in June's downward revision. Second, those data is collected from administrative sources, which should have a relatively good precision, but it's not related to response rate. And third, if you look at the actual response rate, it was actually higher than the same period last year. So where I'm leaning is, based on all these reasons, I could not I haven't yet pinned down the exact reason whether we should really take a strong signal from these downward revisions. Now, on the other hand, pulling the other direction, where I think these downward revisions might be telling us a signal, is that they exactly match what one would have thought 3 months ago. So about 3 months ago, we wrote, right after the liberation tariff, we wrote a piece saying that the next 2 months, meaning May and June's payroll, would be a bloodbath. And I call it a bloodbath because my observation is that in May and June of each year, typically 3 sectors drive hiring. They are construction, leisure and hospitality, and logistics. And the source of these downward revisions we saw from last Friday exactly is coming from these 3 sectors. And so when you look at the revised data from last Friday, it fit this story very neatly, the story that we were telling 3 months ago, that all this trade policy, all these uncertainty should be dampening. Logistics sector, the construction sector is being weighed down by elevated interest rate and the deportations, lack of availability of undocumented workers, and also leisure and hospitality is also seeing a downturn because fewer tourists wants to come to America. And so in that sense, I mean, to the extent that that reflects confirmation bias, I mean, and I think a lot of the narratives in the social media trying to explain this downward revision over the weekend is heading toward that direction because it makes sense. It's the neat way to think about. It's kind of like a confirmation bias kind of story because everybody thought these things are going to impact the sectors as such. But just as a forecaster, have models, forecasting real-time non-farm payroll, we have found that there has been a breakage between these models and what we saw last Friday, and I still could not explain it from that technical perspective. So once I'm able to reconcile that technical perspective and I find a satisfying explanation from that side, then it would fit neatly with the, confirmation of what one would have thought indeed would happen. Mm-hmm. But I haven't found that reconciliation yet.
Yeah. If I recall correctly, wasn't it around this time last year? I feel like it was in August where we got the downward revisions for the non-farm payrolls. I want to say it was like 8 months worth, right?
Yes.
Okay. Let me ask you this, because the NFP number, I feel like it's one of those numbers where, at least from my experience of folks who are like traders on Wall Street, it's one of those data points like everyone's paying attention to that first Friday of the month. So I guess my question is, when you see, I don't know, like revisions like this or what we saw last year, I wonder if it's, one, frustrating, but two, like, could that just impact so many folks' models and like how they're like thinking about the economy? I imagine it's an important component, but it's maybe a bit of a naive question, but it does feel like there's so much weight that gets put on this particular piece of economic data.
Yeah, by every kind of metric, the non-farm payroll report is the most market-moving economic indicator. It's the most important economic indicator, period, across all countries, all economic indicators within the U.S. So I think right now, everybody on Wall Street is trying to figure out what is real, what will be revised back up in this day, in this jobs report in the future, how much signal to take from it. Is it a fluke? Or when something really makes you question the entire narrative, when something, and this is what last Friday's payroll did, it makes you question everything that you know, and it makes you revisit everything that you know. This is purely my speculation. I'm speculating that this jobs report is making all these macro traders kind of revisit their positioning, and people are probably thinking, should I really reposition this whole thing, or is this going to just bounce back as everything would self-correct in the next month?
Yeah, I did see. Okay, so on Friday we also had President Trump, who fired the Bureau of Labor Statistics commissioner, the head, rather. I also saw that Ray Dalio even put out a tweet that he probably would have fired the head of the Bureau of Labor Statistics too. And he said that's because its process for making estimates is obviously obsolete and error prone, and there is no good plan in the works for fixing it. He had obviously a longer tweet than that. I don't want to read the whole thing by any means, but I guess it kind of makes me scratch my head too of, how can we be so error prone with the data? It's such an important piece of data. Why do you think it's so prone to errors? Or I don't know if you have a point of view there, or how we could fix it or measure it better.
So one big source of error or imprecision in each month's employment report is the birth and death model. And what this is basically that it's very hard to measure in real time how many firms are going bankrupt and how many new firms are born. And so BLS relies on a forecasting model that relies on data a year ago or even more than a year ago to estimate a component. So each month, what they do is they take this forecast from this birth and death model and then add it to the survey-based counts of jobs, and then that produce the non-farm payroll data that everybody pays attention to. And so what has happened during the pandemic was that many firms are suddenly dying, and also many people started going for gig working, partly because inflation was high in the last couple of years. It's also easier than ever to be an Uber driver or deliver. So these gig workers would be counted as new firms, and but the definition of a new firm in this sense is different than a decade ago, when a new firm would actually hire a couple of people, right? A startup, whereas a gig worker is just self-employed, right? And so as a result, while it may be true that many people are working for themselves since 2020, they are not generating as much spillovers to broader hiring. And that would be one source of overstatement of the non-farm payrolls, since the model is basically thinking that these new firms, single-person firms, may be producing more than one job, in fact, multiple jobs. So that's one source of error. And so, yeah, I think BLS model for birth and death may be due for a rethink, and that I think that was what maybe Ray Dalio was indirectly attributing to in terms of the, what's obsolete about the statistical method producing the jobs data.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. How do you think this report that we saw on Friday, how do you think that might play into what we could see from the Fed in September? Do you think does it increase the likelihood of a rate cut? Are you expecting a rate cut? I'd love to hear maybe your thoughts on the Fed and your outlook there.
Yeah, so Powell just said last week in the press conference that the main indicator that he's looking at is the unemployment rate, and this was from a reporter's question on what number in a payrolls report would make you think that we're at an equilibrium hiring rate. So basically, Powell was downplaying the importance of the headline payrolls and putting a lot more emphasis on unemployment rates. And why is that? Because the labor force has been contracting for 3 straight months. And the unemployment rate, therefore, can tell you more about the relative conditions of labor supply versus demand. So if labor supply is going down as labor demand is, then the unemployment rate would be roughly stable. And that's what we are seeing in the unemployment rate. So forget about the payrolls numbers from last Friday. If we look at the unemployment rate, it's not that alarming. It went up by by 0.1 percentage point from 4.1 to 4.2. And so from that perspective, the Fed is not that alarmed. And I think that this is the reason why I think September rate cut is not a shoo-in at all.
Not a shoo-in at all. How about just for the rest of the year? How are you thinking about the Fed and rate policy?
Yeah, so to think about the Fed, basically, one needs to put 80% of their effort on forecasting inflation and jobs. Once you get those two pieces right, you basically have a 99% chance of getting the Fed right. That is in normal times. But recently, of course, there's another new element to Fed watching, which is who's going to replace Adriana Kugler, this political pressure. But let's focus on the data piece first. So inflation, we have two more CPI report before September's FOMC meeting. And markets has pretty much markets really think that September is a shoo-in. And I think the idea is that they think that they believe in this 35,000 3 months hiring trend that the new latest jobs report suggests. We don't think 35,000. We think that number might be revised up in the next couple reports. So we're not taking too much signal from that yet. However, we're paying a lot more attention to what will happen to inflation. So my team, to get a sense of how prices are responding to tariffs, we have been scraping online prices everywhere. I call it our 12 million prices project. We are not a billion prices yet, but we're at 12 million. And so what we are seeing there is that there are a few categories where prices have already risen by a lot in the last 3 months. So I know there is this mainstream narrative that tariff pass-through has just begun in the most recent payrolls. But what we have seen in the prices is it's actually well on its way for many types of goods. For example, audio equipment, sporting goods, all those have seen tremendous price increase already. Audio equipments have seen over 11% price hikes, and sporting goods also is around there. Also, household appliances. If you are thinking of buying that Ninja or toasters or whatever for your kitchen, I would recommend buying it because those are already, is about to keep marching on. But we have seen price hikes in those areas already. And what our exercise showed us is that, in fact, consumers are pushing back against those price hikes. And those goods have already seen peak pricing. In fact, they're falling now because consumers have pushed back and they realize they have overstretched the price hikes. And then there are, of course, other stuff where we're just seeing the beginning of tariff pass-through. And those things are like apparels and toys. And I think it's because last couple of months, consumer sentiment was down, and people were still reeling from the shock of the liberation policies. So people are not buying toys or these apparels or these discretionary stuff. So firms basically have no pricing power. But now that consumer sentiment have improved, that now firms have more pricing power in those categories. And we're seeing consumer demand picking up in things like toys and clothes. And this is one reason why I was I was a little bit skeptical of last Friday's payroll report, because from what we have seen in consumer sentiment, things seems to be picking up from the consumer side, and understandably so, because most of the swing consumption in this economy is done by the top 20%. Based on income and wealth. And with the stock market booming, recovered all their drop since mid-April, even making new heights, you could immediately see that those top 20% are indeed coming out to travel more, spend more on hotels. We're seeing signs that the hotel pricing is stabilizing, airfares is stabilizing, and suddenly all the stuff that contributed to the disinflation in April, May, and June are kind of coming back. And so I think my overall read is the next couple of months of inflation print, we would see a brisker pace of services inflation that rebounded from that disinflation in the last 3 months. And second, we would see a mixed evidence of tariff pass-through, with some passing through more briskly, but some not so much. But really, I think the turkey and the entree plate in this whole inflation data watch really is services. And I think so our team's baseline is we will get a couple hot inflation print in the rest of the summer, but the story is not as the simplistic story goes of, oh, it's because of brisker tariffs. No, it's more of a service story.
Can
And
you elaborate a bit more on the service part of it? That's interesting. Yeah.
yeah, so I think the a very simplistic read of the impact of tariffs on inflation is that the higher the tariff goes, the higher inflation. And I think that's the excessively simplistic story because what happens is that the US economy is a service driven economy. In a CPI basket, over 75% are services, right? So what happened when you have a massive shock from the tariff increase, the highest tariff increase in 100 years, is that consumer sentiment immediately comes down, and that immediately cooled the services sector. And before this year, it is the services sector that's causing inflation to be running higher than the Fed's 2% target. That is where the sticky inflation is. So this sharp drop in consumer sentiment post Liberation Day immediately cooled airfares, hotels, car rentals, all these stuff that was actually producing a lot of the upside inflation surprises over the last 2 years. And this is coming from somebody who watched these monthly CPI print, and I cannot recount how many months were the upside surprise due to hotels or airfares. But those were all surprising on the downside in the last 4 months. So whereas the tariff piece is not at all clear because the goods inflation on a year-on-year basis actually has been rising since the middle of last year. It didn't just increase this year. It started in the middle of last year. And so I think what happens is that when tariffs is too high, it is actually disinflationary because the services component more than overwhelms the goods component. But I think the part where tariffs is inflationary is if you have the tariffs, and on top of that, you have something that's boosting the income of everyone, be that stock market or be that wage hikes and all that stuff, or stimulus checks or all that. Then you have this negative supply shock, positive demand shock, and that's where you get that price, that inflation that basically we saw from 2021 and 2022. 2021 and 2022 basically is a story of you have this adverse supply shock, and then you have these massive fiscal checks in combination. And most of all, if one have some knowledge of how the CPI, what drives the CPI, one would know that cars really matter. And then that's the first place where this pop of inflation will happen. And so if I were to think, if I have to tell a story of how tariffs could be inflation, I would say this. So you have the tariff policy stabilizing, and on top of that, it's lower than what most people assumed. So that would generate a positive boost to the stock market because people are like, oh, uncertainty is resolving. It's not as bad as I thought. So you have that positive income shock to the top 20%. And these people are the one who causes swings in hotels and airfares prices. And then on top of that, you have stimulus checks you pass along to the bottom 20, bottom 40%. And those people most likely will use that to buy a car that that's what, so many academic studies did look at what people used their stimulus checks for back in 2021 and 2022. And it's cars, used cars in cars. And so then you get that pop in car inflation. That's how you get a really hot inflation print from tariffs. And I would say that so far one of those two is happening. And so it's not at all straightforward. Is it one-on-one higher tariffs equals higher inflation rate. Not at all. It's more like there's this middle part where, right? You understand what I mean,
Yeah, no, I know.
Julia?
Yeah, exactly. It's like you're just getting me thinking about so many things because this is so interesting. I hadn't heard someone articulate it the way you did. And when you talk about that top 20%, and also when you look at where the market's been headed, we've even rallied back from Friday's drop. So we're not at the all-time highs, but we are pretty high right now on the markets too, and like how much of a factor that's been on the inflation side despite the tariffs.
Yeah, I think because I think many people have already moved past the tariffs. Many people many market participants are already thinking about one big beautiful bill,
Mhm.
and because this is basically resolving one source of policy uncertainty, tax policy uncertainty. So firms who are thinking about what should they do, how should they plan their capex, now are guaranteed with, they know for sure what will happen to their tax credits. They can go ahead and plan. And so, and also in terms of tariffs, it seems like the deal with Japan and EU are sufficiently reassuring for many investors that, they're okay with this. And then also rumors of another 90-day truce with China is also helping the market. So I think all in all, with the resolution of policy uncertainty recently, is actually boosting the economy. And I think, if I were to be forward looking, that's what I think the impulse should be.
Mhm.
But let's not forget that the tariffs is basically equivalent to about 1 percentage point of negative or contractionary fiscal impulse this year. So whatever effect is this, the boost from resolution of policy uncertainty has to be exceeding 1 percentage point to actually, get the economy to grow beyond potential GDP. I think that's unlikely. So that's why our forecast for the whole year GDP is still between 1 to 1.5, which is basically lower than the potential GDP growth rate.
Going back to the importance of paying attention to what will happen with inflation, specifically looking at the prices and how they would respond to tariffs and whatnot. How, just to reiterate, for the Fed though, does that mean, from your viewpoint, like higher for longer? Or what? How are you? Again, just want to clarify how you're thinking about the Fed.
Right. So we think our baseline is for the Fed to lower rates or resume lowering rates in December of this year in the last meeting. And that's because, our expectations that in inflation will be, we will see a couple hot inflation print in the coming months. And also, before last Friday, we were also thinking that the labor market is probably stabilizing. Um, so I think all of that means that the Fed probably won't have enough confidence to lower rates until December. Particularly also that I think the Fed still holds the view that the higher the tariff goes, the higher the inflation will go. And we have not seen peak tariff yet. We still have those sectoral tariffs. The completion of Section 232 means that more sectoral tariffs could come, and that could boost effective tariffs by another 5 percentage point or so, at least. And so, and also there's also those 90-day truce with China. And so I think the Fed will have to are restrained from acting because they don't know if that tariff uncertainty would mean that tariffs could actually go higher later in this year.
Let me ask you this. I was looking at your background. So in 2019 and 2020, you were seconded to the White House Council of Economic Advisors. I would love to hear about that experience. And I imagine there's probably you were probably working on trade or tariffs even back then. What's been your overall assessment of tariffs? Like, how do you kind of think about, um, how they've been successful, things you might recommend doing differently? Just kind of more curious of the big picture for tariffs.
Yeah. Yes, Julia, those 2 years were really formative for me. Um, so I think working in the White House in 2019 and also in the middle of the pandemic in 2020 helped me uh, question more of the conventional wisdom that I mean, I came from the mainstream background in terms of training, and so um, in 2019, on the trade war, I think the key surprising thing is the effects of tariffs transmit to the economy. And what was surprising is that there was not much inflation impact and not much GDP impact. And I think many very serious academic research since then would agree with that view. I mean, I know people would cite washing machines and dryers as a poster child for tariff pass through, but what matters for the Fed and for most Americans is the aggregate net impact, right? And and also what I learned is that the key negative impact of tariffs on the economy comes through the uncertainty channel. So what's really real is that tariff uncertainty will dampen investment. That is, there's very, very clear evidence on this. So this is how I extrapolate that experience to this time around, which is I think that the resolution of many of these deals would actually boost investment. This is what I know for a fact, that there will be a clear effect there. And then in 2020, I was also I was the first economist to sit in the Situation Room on coronavirus in January 2020 because it was seen as a international economic issue as opposed to domestic, and I was the chief international economist at CEA. I think the biggest lesson I learned from that era is so a big policy question back then was travel bans. To what extent and how fast should we be imposing travel bans? And economists would review economic literature from the to look at the effectiveness at travel ban, and the finding would be it doesn't work, don't recommend it because people could usually travel around to a third country and get in anyway. And the only way that travel ban would work is in an island like New Zealand. And so, we recommended not to have the travel ban. And on hindsight, I think I regret it. I regret that decision because I think what we learned is that travel bans, yes, it could not stop the inflows of people. However, it would slow the process down. And for a thing like the coronavirus, slowing something down could actually save life. And typically in economic policy making, nothing is life and death like that. But certainly, that type of experience is life and death. Now, how is that related to today? I actually see tariffs quite similarly as travel ban. One would think tariff. One would think that, well, it's true, tariffs cannot really stop trade from happening. At the end of the day, it's the saving and investment accounting, identity that determines the trade balance of a country. However, I don't think that's the right question. The right question is, can tariff slows down the process of the hollowing out of the manufacturing uh, um, industry in the U.S.? Could it slow down some of this stuff that we're so quickly losing because of very cheap prices abroad? And to what extent are these things that are going away because of trade have national security value? Because the economists are also terrible at putting prices on national security. So I think the humility I learned from 2020 is number one, economists are terrible at putting a price tag on human lives or on national security, and so that's I think whether tariffs are valid is not strictly an economic question. There are many angles to it, and I think many different professions should contribute to the determination of the appropriateness of tariffs.
Wow, I love it. Anna, I've enjoyed my time with you. I want to see if I can sneak in a couple more questions before I let you go. Let me ask you about markets. We've kind of touched upon it in passing, and I know you don't talk about individual equities or anything like that, but maybe more from that economist lens. What do you make of where we are as it relates to markets?
Well, I think the market is really driven by TACO and FOMO right now. And I think the market is very optimistic right now. And whether that optimism is on solid ground, I think that, judging from the market reaction we saw last Friday, massive swings, it's like one single data point can change your mind about the entire thing. That tells you nothing is on solid ground. And so I would say the market, one thing for sure is that market is set for huge volatilities.
And this is a two-part question. What is that risk that is on your mind that's keeping you up at night? Doesn't have to actually be keeping you up at night, but it's keeping you up at night that you can't stop thinking about. And what is something that is making you optimistic?
Yeah, that's a good question and a rare question. That's nowadays very rarely would people ask that question. Um, so, um, so a thing I worried about is whether we are already in a recession, because if you trust what you have seen last Friday, that 3 months moving average of hiring is at 35,000, adjusted for that 80,000 extra overstatement from not birth and death, you're at negative 50K. And clearly that would be recessionary. Another thing is, based on other uh, indicators, such as the farm rule, the recession actually would have begun last April, or there's a decent probability it has started last April. What if we are in a recession and people haven't noticed it yet? So that's one thing I worry about. Second, of course, is just like anyone, data quality. There's clearly a lot of federal statistical agencies are stressed and are short-staffed. And how do we ensure that the data that we're receiving is accurate as much as possible? And I think, uh, and even if they do have the resources, whether the integrity of those organizations would be subjected to questions. And, no matter who is installed to replace the BLS head, whether that person would be subjected to a lot of, will be operating, operating under a cloud of suspicion. So I think trust is very important. And also, if data quality deteriorates from now on, then we'll get a lot more of last Fridays where you feel like the rug is pulled underneath from you, as everybody market would be more volatile as a result. I think those are the things that I worry about. In terms of optimism, so I'm optimistic that I think the narrative on tariffs are slowly shifting. And the thing is, in the original economic textbook, it actually presented cases for how and what tariffs could increase the welfare relative to no tariffs. And one of them is that you have to ensure there's no retaliation. And I think what I'm seeing is we're seeing that the Trump administration is extracting these things from other countries without generating retaliation. And that is actually adhering closer to this path of potentially creating actually a path for tariff to be boosting welfare. So I think the second part I'm optimistic about is resolution of uncertainty. I think that the one big beautiful bill is going to boost investment from here on out. Um, so so that so I think those are investment uh, and domestic manufacturing industries to the extent that they could be reshored. I think I'm more optimistic about those than your typical Wall Street economist. I will add one more thing I worry about. I forgot to talk about this thing is AI. So China is more advanced in AI than US in some ways. And in terms of, I would say, the adoption of AI in everyday life, China is pretty much ahead, right? And you can already see how it impacted the youth employment and people who graduate from college. And so in the last 5 months of jobs data, what we are seeing is that um, the people in their 20s are dropping off from the labor force. And I worry about whether the faster AI adoption is, it could be very destabilizing for entry level jobs. Many entry level jobs will be gone, and as a result, we have this the generation in their 20s right now, and the next generations what skills will what kind of skills do they have to be retooled with in order to be a productive member of the society? And so I think once again, this is not something that economists are good at. The transition period. I think economists have a pretty satisfying answer for okay, if you have AI, this is great, it will boost the economy. This is the long term game. But then they're not really great at talking about the transition. Like how will all these people who will be losing their job. What are they falling back on?
Anna Wong, Chief U.S. Economist at Bloomberg Economics. Thank you so much for being so generous with your time, all of your knowledge, helping us all learn and get better. Really, really enjoyed having you on the show. Thanks again. And until next time, be well, Anna. Really appreciate you.
Thank you.